Welcome. We're now working on Chapter 2, Exercise 2-8. This is your homework problem on Wiley Plus. We're going to take a look at the problem that's there at the end of your textbook, at the end of Chapter 2. The numbers are going to be the same as we're reviewing it, and as I had done in Chapter 1, we're going to use Microsoft Excel to work on this exercise over here for now. So in this exercise, we have Fairview Corporation. At year-end, July 31st, 2017, we've been given various accounts, the balances in each of these accounts. In parts A and B, we've been asked to prepare the income statement, statement of retained earnings, and a classified balance sheet. And we've also been told in part A that the company did not issue any new stock during the year. In part C and D, they've asked us to do some analysis, and we'll get to that after we prepare our financial statements. So to quickly review our financial statements, the layout that we have, I have prepared the skeleton for 3 statements. For all 3 statements, we always start out with the name of the company. In the next line, we identify the name of the statement. So we have the income statement, statement of retained earnings, and the balance sheet. In the third line, I have the time period. For the income statement and the statement of retained earnings, it's for the year ended July 31st, 2017. For the balance sheet, it's always as of a particular date, and the date here is July 31st, 2017. In the income statement, as we recall, we have revenues and we have expenses. Statement of retained earnings, the format is always the same. You will have retained earnings beginning balance. We will add net income, which we get from the income statement. When you combine those 2 numbers, you come up with a subtotal. We subtract dividends if any dividends were paid out. And then we have the retained earnings ending balance. In the balance sheet, we have assets, liabilities, and the shareholders' equity. If you notice, I have laid out the balance sheet a little differently. And it's nothing but a presentation format that's different. In this case, what I have done is I have the assets on one side. On the other side, I have liabilities, and I have shareholders' equity below that. And the only reason I've done this over here is because if I listed out liabilities and shareholders' equity below that, it would not fit on one screen. No other reason why I'm doing this format of presentation. Also, under shareholders' equity, as I told you in the previous chapter, typically there are only 2 items you're going to see over here. Those 2 items are going to be common stock and retained earnings. You're not going to see anything else over here. So let's go back to our textbook and look at the problem and see what items we have and what these items are, what financial statement they belong to. I've already told you there are some tips. When you see the word expense, you know it's an expense. Revenue means it's a revenue. You see the word payable, it means it's a liability. And if you see the word receivable, it's an asset. So let's go down the list. We have salaries and wages payable, therefore this is a liability. Salaries and wages expenses is an expense. Supply expense is an expense. Equipment is an asset that the company owns. They're going to use it in the business beyond the current period. Accounts payable is a liability. Service revenue and rent revenue are revenues. Notes payable is a liability. Now let's go back for a minute over here. Salaries and wages payable and accounts payable. Who are we going to pay the money to? Salaries and wages to employees, accounts payable to vendors. How long do we typically have to make that payment? Salaries and wages payable, 2 weeks to a month. Accounts payable, 30 to 90 days. Notes payable, well, it depends on what the terms and agreements were. In this case, they are saying it's due on 2020. The reason I'm pointing this out is these liabilities, the 3 liabilities we have, they're slightly different. Accounts payable and salaries and wages payable are considered current liabilities because they're going to be due within the next 1 year. Anything that's due beyond Next year, that's if it's not due by July 31st, 2018, it's considered a long-term liability. So notes payable will be classified as a long-term liability. If you recall, we are preparing a classified balance sheet. We are trying to identify when this is due. Common stock is an equity item. Cash and accounts receivable are assets. Once again, let's step back and see what's the difference between equipment and cash and accounts receivable. Cash is already in the most liquid form. Accounts receivable is money that my customers owe me. And when do I hope these guys are going to pay me? Well, in most cases, businesses expect payment within 30 days. So that's definitely within the next 1 year, so it's considered a current asset. Equipment is not going to be sold. It's kept in the business and used to produce revenue. It's going to be kept beyond 1 year, so it's going to be considered a long-term asset. Accumulated depreciation is an example of a contra asset. Its purpose is to decrease the equipment account. Dividends is an equity, contra equity account, and it's going to reduce my equity. Depreciation expense is an expense, and this depreciation expense is really the expensing of the equipment. If you recall in the previous chapter, I had said supplies are assets. Once a supply is used, it becomes supply expense. Similarly, equipment is an asset, long-term asset. When it is used, we don't call it equipment expense, we call it depreciation expense because it's a long-term asset. And then retained earnings, beginning balance is going to go into the statement of retained earnings. So let me go back to my financial statements. I had two revenues. I will list out my two revenues in the inside column, and I'll list out the total in the outside column. My expenses are going to be listed in the inside column. I have three expenses, and I will list the total expense in the outside column. My retained earnings beginning balance was given to me. I was told that dividends of 4,000 were paid out. Okay. Then in my balance sheet, under assets, I'll classify my assets as current assets and long-term assets. So under current assets, I have two current assets adding up to 38,980. I have cash and accounts receivable, which are my current assets. My long-term asset, I had one, equipment. Accumulated depreciation is a contra equipment account, which means it has to reduce. That's why I put that number in parentheses. And when I come up with the subtotal, I call it my equipment is net equipment. In this case, that's the only long-term asset I have. When I put those items together, my total assets work out to 51,480. Under liabilities, I'm going to do the same thing as I've done over here. As in with assets, I had current assets. Here I have current liabilities. I had two current liabilities. Salaries and wages payable and accounts payable, adding up to 6180. And under my long-term liabilities, I had only notes payable, 1800. Current liabilities plus long-term liabilities will give me my total liabilities. My common stock was given to me at 16,000. So all the information given to me in the text, in the problem, I have put it in place. Revenues minus expenses gives me net income. Remember, the word net income is a generic word. If revenues are in excess of expenses, I have a net profit. If revenues are less than my expenses, I have a net loss. So in this case, unfortunately, I have a net loss. My net income, I'm going to put that in parentheses to indicate it's a net loss. I bring that number over here, and my earnings from my previous period that I had is going to get reduced because of the loss in the current period. And I have $31,500 in subtotal. I still have sufficient amount to give out as dividends. In order to pay out dividends, two things have to happen. This subtotal should be a positive number, and I should have sufficient cash. If both of those conditions are met, I can still pay dividends. So although in the current year I lost money, I'm going to pay out dividends in this case, leaving me with an ending balance of $27,500. That number is brought over here to give me total shareholders' equity of $43,500. Now, if you recall, your total assets have to be equal to total liabilities plus total shareholders' equity. And so we will check our numbers, and yes, they do work out. So once again, recall, your net income number is brought in over here. If it's a positive number, you bring a positive number. If it's a negative number, you bring a negative number. Your total assets must be equal to total liability plus total shareholders' equity. If those numbers don't add up, we made a mistake somewhere. Well, in this case, it does add up. So the classified balance sheet, we have listed items as current assets, long-term assets, current liability, and long-term liability. Now, something to note again that's important. I told you in the previous class, you could list your expenses alphabetically. You could list them in the order of the dollar amount. There are many ways in which you can list them, no restrictions. If you're preparing a classified balance sheet as we've done over here, it is important to note over here, these assets over here, the current assets, must be listed in the order of liquidity. Most liquid to the least liquid. Cash is always the most liquid. It is a liquid asset. So what's the next one that can be converted into cash easily? Accounts receivable. Your customers have to pay you the money. Hopefully that is an easy process. So this has to be in the order of liquidity. Your long-term assets typically are listed alphabetically. Not required, but they're typically listed alphabetically. Okay. Now that we have the first two parts done, preparing the income statement, statement of owners, the statement of retained earnings and the balance sheet, let's take a look at part C and D. In part C, they've asked us to calculate the current ratio and the debt to asset ratio. So once again, let's see what that is. A current ratio is nothing but comparing your current assets and current liabilities. It's a ratio of those two numbers. Okay, so what I'm saying is, for every dollar I have in current assets, how much do I have in current liabilities? Because, at least theoretically, I should use my current assets to pay off my current liabilities. I should not use my long-term assets to pay off my current liabilities. That's not a good thing. So a ratio over here in this case is 38,980 divided by 6180, and that ratio works out to 6.31, which for accounting standards and finance standards is a very, very, very healthy number. Most companies aim to have a 1:1 ratio. So 6.31 is a very good number, healthy number to have. So let's look at another ratio that they've asked us to do, debt to asset ratio. Basically saying these total assets that you have, 51,480, how much of that do the owners have a claim against it? How much of it do the creditors have a claim against it? So your creditors are your liabilities. Okay, so we're looking at total debt divided by total assets. And if you look at this number, you will see it's a 15.5%. Basically saying 15% of your assets, those creditors have a claim to it. Not a bad number. actually quite a good number. A lot of firms will aim for 50-50. That's your liabilities and shareholders' equity should be 50-50. In fact, when you start out, you prefer having more in liabilities just in case things go wrong. Then you've lost less of your money because initially what you have is common stock is a big thing, what you put in. In this case, your retained earnings has grown to be a larger number, so that's a very good thing. All these numbers are relative. Relative as in, I want to see what does this compare to my previous year? What does this compare to my competition? If everyone in the industry has a debt to asset ratio of 10%, then I'm not doing good. If everyone has 50%, then I'm doing better. So a lot of it is comparison. Let's look at the last part of the problem. They tell you, suppose that you are the president of Lunar Equipment. Your sales manager has approached you with a proposal to sell $20,000 of equipment to Fairview. That's this company we are looking at. He would like to provide a loan to Fairview in the form of a 10% 5-year note payable. Evaluate how this loan would change the current ratio and debt to asset ratio. Okay. So basically what we're looking at now is we're looking at recalculating these ratios. Okay. So someone wants to sell us an asset. They want to sell us equipment. Will that affect current assets? The answer is no. Am I going to pay cash? No, I'm getting a loan. Okay, so it's not going to affect. The loan comes over here under long-term liability. So my debt will increase, my total assets will increase. My current ratio stays the same. It doesn't get affected. But here what you will see is these numbers are going to get affected. So what's going to happen? My total debt is going to increase by $20,000 because I now owe $20,000. My total assets will also increase by $20,000 because I have an equipment. So let's see what happens to these numbers. So 7,980 divided by 51,480 becomes 27,980 divided by 71,980. Simple arithmetic. Let's do the calculation and see what happens. Lo and behold, look at what happens to this particular number over here. That more than doubles. Okay? Is this significant? This is very significant. It's significant because my other creditors may not be happy with me. They may be upset that I'm borrowing more money. What if I stop paying them the money that's owed to them, etc.? So what we're looking at over here is in some cases, I may actually have to get permission from this notes payable, whoever I owe this money, and ask them, is it okay with you if I create another notes payable in my book? So there are various other management issues that will have to be addressed if you decide to go with this acquisition of an asset. It may not be bad in the long run because if I have another $20,000 in equipment, maybe my production is going to improve. Whatever work I'm doing, I'll be able to generate more in revenues. And that may not be a bad thing at all. So the real issue is, if it's a 10% loan, I'm paying 10% on 20,000, that's 2,000. Will my revenues increase by 2,000? If it increases by more than 2,000, I can justify interest expense of 2,000. So I hope this gives you an idea as to how we can start using this income statement a little more dynamically. Income statement, statement of retained earnings, as well as balance sheet a little more dynamically.